Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Academy's weekly podcast. We'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, along with my co-host and business partner, Charles Dehart. Charles, what's going on, man? You're back from cold Buffalo. You were up there in the middle of the winter time. That's a horrible time to go up there. How you doing, man?
Good, doing good. It was a perfect weekend this last weekend, so definitely glad to be back.
It actually wasn't even warm up there. I mean, it wasn't even cold up there. It was like 50 or 60 degrees, which is crazy. Normally, that's like the one place you don't want to go in the middle of winter is Buffalo, New York. And Charles trekked up there and had beautiful T-shirt weather.
Yeah, it got me. I mean, I was 50 degrees both days that I was there, and then I woke up that morning just kind of expecting the same thing the morning that I flew back, and it was about 10.
Oh,
and I got froze to death walking to the car. So,
wow, you were in your Florida flip-flops and T-shirt, huh?
Yeah, I was just wearing a windbreaker and about froze to death, so.
Good deal, good deal. Well, you're back. You made it back safe and sound. So that's part of the show that we're going to do today. We'd like to share the updates from Charles's trip to Buffalo, because there's definitely some unique components of this deal. Some, I guess, you don't know to call them challenges, but I mean, there's some things that we're working through in due diligence that may make or break the deal. And so we're going to share some of those with you and discuss how we're looking to overcome them, if they're even possibly, if we can overcome them. So we'll share those with you, as well as we'd like to give you updates on a park that we own in Alabama, which we actually shared a case study on way back in episode 29. This is a park that's in the Huntsville MSA, and I'm going to tell you that you're going to want to stick around for this update on the Alabama park, because it details our experience with using the 21st Mortgage Financing Program to sell off our used home inventory in this park. And we're going to share with you the challenges that we've been experiencing with it. So in that park, I'll just give really brief details. In that park, we acquired 45 park-owned homes, and there's 25 or so vacant pads. And our goal was to convert the park-owned homes. They're really nice, newer homes. We're going to convert them back to tenant-owned homes using the financing program through 21st, and then bring in new homes to fill in the remaining pads. And we've been having a lot of challenges with that. It's working, and we're chugging along, but we're definitely having some challenges. And so we wanted to share those with you so that you guys can make the proper decisions if you're looking at parks that have a lot of park-owned homes that you intend to sell off, okay? Sometimes it's not as easy as you might think it is. And so we'll share that with you here in a little bit. But before we get onto the show, I want to go through a few laundry items. The first one is, Charles, the Academy, man, it's here. It's arrived. The mothership has arrived. We've launched, dude. Can you believe that?
Yeah, it's great. It's been great so far. We've actually taken in, a number of students, actually, and we've had a chance to work with some of these students already, and it's been good.
Yeah,
we're moving in the right direction, starting to get some mail out, and it looks really, really good.
We've got a group of winners, man. I mean, we're definitely going to have. I can't wait to see those first success stories where the students make it through and they get their first park. And I know it's going to happen based on the feedback that we've received and just even the questions and the interaction that we've been getting from our current batch of students. I mean, I don't know. I don't know about you, man, but I'm excited about like that finish line for them and just watching them go to the closing table and execute that first deal. So, it's interesting, Charles, because we've been working on this now for a year and a half or even more than that. There's not a lot of education out there on this topic of mobile home park investing. I mean, there's a couple other guys that do it. Charles and I have been through pretty much. I don't know, Charles, I'll speak for myself. I've been through pretty much every training out there. I've read every book on the topic. I know you have as well, so I'll speak for you as well. But we've gone through every training. I mean, that's possible on this topic. And I will confidently say that our program, that the Academy is, it's hands down the most comprehensive training on mobile home park investing that anyone could find. Would you agree with that?
I would.
And that's
especially with finding deals.
Yeah. I mean, it's a biased opinion because it's our opinion, but it really is. I mean, it's a 90-day intensive program. Nothing else out there even competes with it, and we go into detail of everything and anything from market analysis to building a database to marketing to direct cold calling, direct mailing to operational side to raising private capital, all the way to hiring the correct manager, interviewing and hiring the correct manager, and it's just it's a very, very comprehensive program, and I think that those that are out there that want to get into the space, they'd be crazy if they didn't consider the academy if they want to dive in and learn this business the proper way. So anyway, that's all I have to say about the academy. It's live. I'm excited. You're excited, and I know we got a ton of students out there that are they're just as pumped as we are. And so for those that are considering getting into this space, Charles, I'll say this before we move on. For those that are considering getting into the space, you owe it to yourself to at least go check out our website, mobilehomeparkacademy.com, and check out the free training that Charles and I put together. We actually did this. Charles and I we put our heads together and we said, you know what? The academy, it's not cheap. You're not going to go spend $97 a month getting to the academy. I mean, this is not that type of program. This is this is a comprehensive program that's going to show you everything you need to buy your first park. And so it's not some diddly, $97 a month program. So it is expensive, but what we've done is we've taken the time, we put together a 2-hour free training, a very in-depth training that will actually go through 3 different subjects that are very, very, very important. And we go into much more detail in the academy itself, but we've got a free 2-hour training on our website that you can watch that will go through the market analysis side of things. It'll go through building your comprehensive mobile home park database and also how to market to these different off-market parks. I mean, this is our business to a T. This is exactly how we do it. And so we have a 2-hour training that you can watch on our website. You just literally have to put your name and email address in, and you get access to it. So, Charles, any thoughts on that 2-hour free training? I mean, it's a no-brainer, right? I mean, it's free. So what do you have to lose?
Yeah, it's free. So I don't know why you wouldn't do it.
Yeah. It's funny. I've actually been a bunch of people have reached out to me saying, "Hey, man, I've got like 3 pages of notes from just that 2-hour training." So it's definitely very, very comprehensive. So anyway, that's enough about the academy. Go check it out, mobilehomeparkacademy.com. You can read about it. You can watch that free training. If you have any questions about it, you can reach out to us directly, mobilehomeparkacademy@gmail.com. Now, in addition to our academy, which we're so excited about, we also just launched our highly anticipated mobile home park investment fund. It's live and it's open for business. So if you have any interest whatsoever in partnering with us, go ahead and shoot us an email directly to partner@mobilehomeparkacademy.com. And that's an autoresponder email for those that have an interest in partnering with us on our investment fund. Almost immediately, you'll get an email back that will offer you a link to our current offering. And it'll also give you a link to our calendar so that you can schedule time to talk with myself or Charles about this investment opportunity, okay? And one other thing, based on direct feedback that many have shown us, many that have shown an interest in partnering with us on deals, a lot of people want to kind of learn the mechanics of investing in mobile home parks. They don't want to just be passive, which is more so what our investment fund is. But a lot of people have shown an interest in actually learning the mechanics and the internal operations of being a mobile home park investor. And so what we're doing, Charles and I decided to create somewhat of a hybrid fund. And so our investment offering, our partnership offering, we're calling it a hybrid investment opportunity because not only are you going to get to invest next to us in deals, but we're also going to give you lifetime access to the Mobile Home Park Academy. Okay, so if you invest in our fund, as a default, we'll give you lifetime access to the Mobile Home Park Academy. That way, if you truly want to learn this business and you want to learn the internal operations and mechanics of how we put things together, you have it right there in the academy. In addition to that, you get to work side by side with us and invest in great opportunity. So anyway, that's it, guys. Just if you have an interest in the fund, if you have an interest in the academy, make sure you reach out to us. We'd love to give you more information on it. A few last laundry list items here before we get on to the show is if you're ever in the Tampa Bay area, that's where Charles and I are based out of. We're located in Clearwater, Florida, near Tampa. Reach out to us. We'd love to meet with you. We love meeting others that are that are in this business, whether it's real estate in general or if you're in mobile home parks, we'd love to meet with you. And just if you share a passion like we do for real estate investing, shoot us an email. We'd love to coordinate our schedule so that we can get together while you're in town. mobilehomeparkacademy@gmail.com. Lastly, as you've noticed, if you've been listening to the show, you notice that we've interviewed a lot of mobile home park investors over the past couple of months. Well, We want to interview more. If you're a mobile home park investor and you own at least one park, that's all. It doesn't even matter if it's a small park. The last guest we had on the show, they owned an 11-space park in Connecticut. So you don't have to be some mobile home park mogul and have hundreds or thousands of spaces. You can own just one park. We'd love to have you on the show. We'd love to discuss your journey, your experience of being a mobile home park operator, and share that story with our listeners. We all learn from one another, and we love to share your story so that others can learn from it as well. If you would like to be a guest on the show, shoot us an email, mobilehomeparkacademy@gmail.com, and we will schedule time to get on the phone together to talk about bringing on your show as a guest. So without further ado, Charles, let's get on to the part of the show that everyone's been waiting on, which is the meat and potatoes, man. So as I mentioned, we're going to talk about the Alden deal, your recent due diligence trip, and we're going to talk about the Alabama park. But let's start off with the Alden deal. Give us some of the feedback, or maybe start off with the background of this Alden deal. Tell listeners a little bit more about it. What we're paying for it, the size of it, how many occupied lots, and kind of what really excites us about the deal overall.
Yeah, this park is a 53-space park. It's in the city of Alden, which is about 15 miles. I think 15 miles to the east of the Buffalo, New York airport. So it's about probably 25, 30 miles to the east of the city center of Buffalo, New York. I think you actually found this on LoopNet. Was that right?
I did. It's one of those needles in the haystack on LoopNet. But yes, I found it on LoopNet. Okay. Yeah, it was basically the guy that owns this park. He's a large apartment investor, and he when he bought his last portfolio of apartments, he had to take this little mobile home park with the 1,500 to 2,000 units of apartment housing that this thing came with. So that's how he ended up with it. It's managed by a third-party management company. So that right there, obviously, pretty much any time you see that in a mobile home park, you're going to have operational inefficiencies and, just mismanagement in general. So it's a 53-space park. It's got 37 paying lots right now. So it's 37 people that own their own home and they pay lot rent. The current lot rent's $310. And water and sewer is directly billed in this park. And in addition to that, there's a little duplex at the front of the property on its own separate parcel that comes with the sale. And then there's 8 vacant junker park-owned homes that also come with it. That's pretty much the basics of the deal there. Buffalo, New York, the lot rent being $310 is far below market. And this is one of the things that really excites us about this park is that the lot rents in Buffalo, in that part of the Buffalo market, are well over $400. That's your average lot rent. And some parks are even at right around $500. Mm-hmm. The school district for Alden, the Alden City Schools, they're actually pretty phenomenal. They're one of the better schools. I think it might even be the best school district in Buffalo, New York, in that market. And as we said before, we've got this duplex that's already on a separate parcel. And we've got an interested buyer for that duplex already lined up at around $140,000. So our basis for the park at this point, if we wind up selling that duplex, is right around $640,000, which we think is, we think it's a pretty good deal at that price point once we get rid of the duplex. Mm-hmm. So those are some of the things that really excite us. Some of the things that. One of the reasons why we tied this park up, and I ultimately made a trip out there. So that's kind of the basics of that deal. So that's the good. Actually, there's one last thing there regarding the taxes. Right now, the tax assessment of this park is pretty high because the purchaser, mm-hmm. actually the current owner that bought this park, he was kind of forced to buy it. He bought it with a package of apartment buildings, and so he kind of maybe didn't overpay, but he paid more than we're paying for it. I think it's safe to say that. And so the tax assessment on this thing is, Charles, I believe it was close to $1 million, wasn't it?
Yeah, I mean, that area has a really high tax rate. So, we're basically, we haven't decided yet. We'll have to get with our CPA how we're going to, allocate the different parts of the sale. But, any way you slice it, we're going to be at a lower basis than $1 million, mm-hmm. which is basically what they're assessing the thing at. And the tax rate is right. It's very close to. It's not quite 4%. I think it's like 3.8 or 3.9%. So on $1 million property, you're looking at $38,000 to $39,000 a year. So if we can get that reassessed at the $600,000 to $700,000 mark, it'll cut our property taxes by a third. We've been successful at doing that in the past. Usually you have to have an appraisal, which we're going to have because we're doing bank financing on this park. So we'll have an appraisal to hopefully support our opinion. Hopefully the appraisal won't come in at $1 million or something like that. But that we've had some success in the past fighting taxes, and that's what we plan to do in this one.
Okay, well, sounds good. So that's kind of the good. And before we go into the bad, Charles, because that's where we're going to next, that's where we're heading next, I'd like to just really quickly cover how I found it. So we mentioned I found it on LoopNet, but I think this is a very important point to cover because, I think we poo-poo on LoopNet a lot. Like we kind of call it the broker's trash can, and it essentially is. I'm not taking anything back, bad back that I said about LoopNet, but with that being said, you still should be spending time looking on LoopNet or setting up alerts. With the paid service of LoopNet, you get a little bit more search capabilities, but even the free searching capabilities you probably would have found this park here. And so this park, the unique thing about it is it had been listed for more than a year. And so really, really smart brokers, typically if something stays up for a period of time, they take it down. And they take it down completely and they relist it. That way it doesn't actually show searchers like ourselves, how long it's been up there. Because as you guys know, things that hang out there for a long time for sale, typically the more motivated the seller might become. And so that was the first thing that really caught my eye with this deal. It's been out there for over a year. And it's also had multiple price reductions. And so I didn't really know the story behind it, but it at least piqued my interest enough to call the broker and to get the background story on it. And so as I dug a little deeper, I realized that it was a potentially good opportunity. And I think when we tied it up, Charles, they were asking $8.99 for it, which is overpriced, and it probably wasn't getting hardly any activity. And I think we offered them $730 or $740, and we settled on $780 as the purchase price of it. But I guess what I'm getting at here is that you need to spend time on LoopNet because actually we haven't bought anything on LoopNet for years, but it just happens that right now we have 2 parks in contract that were both found on LoopNet. And they're both seemingly pretty darn good deals. So you need to be looking, you need to be scouring, and the broker on this deal, he is not a mobile home park broker. He doesn't specialize in this space, and so he didn't really even know anything about it. Like the financials weren't really up on the listing. It didn't really have a lot of detailed information. In fact, it took a while for us to kind of dig through it all, but it's seemingly a good deal. I mean, there's some bad components of it that we're about to talk about now that might kill the deal, but overall, so far, we think that we have a decent opportunity here, and it's going to be a great opportunity once we kind of work through some of the somewhat negative components of it. So, Charles, you want to talk about the bad pieces of the puzzle and how they might, negatively affect the deal?
Yeah, one of the bad things about this park is that the lots are a little on the tight side, and then some of the roads are a little narrow. So, especially on one side of the park, you have basically a one-lane road with, it doesn't have a whole lot of room to basically pull in a mobile home. So if we wanted to replace some of these mobile homes, some of these vacant park-owned homes that probably aren't worth salvaging, or if we wanted to fill some of the empty lots with newer mobile homes, it's going to be a little bit of a challenge to do that.
Hey guys, Kevin Bupp here from the Mobile Home Park Academy. I'm very sorry for interrupting your show, but I have something really special I'd like to share with you. If you haven't heard already, Charles and I are offering something really cool here at the Mobile Home Park Investing Podcast, and I just wanted to make sure that you knew about it. We're offering a free 30-minute phone consultation with the 2 of us, where you can ask us anything that you'd like about mobile home park investing. Maybe you're brand new and you just have a few questions that you'd like answered. Or maybe you want to run a deal past us and have us help you walk through the evaluation process. Or maybe you're an already experienced park owner and you just want to bounce a few ideas off of us. Whatever it is, Charles and I, we're very excited to speak with you. And there's absolutely no ulterior motive with these calls, so you don't need to worry about us trying to upsell you or pitch you on some kind of product or service. These calls are simply our way of giving back and connecting with others who share our same passion for this business. And just to reiterate, it doesn't matter if you're brand new or a seasoned investor. These calls are open to everyone. But there is one catch. It has to relate to mobile home parks. And so if you'd like to schedule that free 30-minute call with Charles and I, please send an email to freecall@mobilehomeparkacademy.com. Again, freecall@mobilehomeparkacademy.com, and almost immediately you'll receive an email back with a link to our calendar. And if you haven't received that email within 5 minutes or so, be sure to check your junk folder, okay? Sometimes it ends up there. And when you go to schedule that time on our calendar, please include a little background on yourself as well as what you'd like to discuss on our call. But please be sure that it relates to mobile home parks. Charles and I really look forward to connecting with you, and we look forward to helping you in your journey to success as a mobile home park investor. Now let's get back to the show.
So we're going to have to obviously do a little bit more due diligence on that. And then as far as the city is concerned, they have some setback requirements that are, they're a little bit on the weird side. It's not really legal for them to have, they can have this opinion, but it doesn't, it's not really the right way that grandfathering is handled. They view any lot that goes vacant in the mobile home park as having to conform to the newest city code, which means that one of the setback requirements in the city code is that you can't place a mobile home that is within 100 feet of your property line, so of your neighboring property, which is it would be virtually impossible to comply with because almost all of the homes in the park would be within 100 feet of the property line, either on either side of the property line. So, their interpretation is that any lot that goes vacant, so we pull out one of these old junker park-owned homes and replace it with a new home, we'd have to conform to that 100-foot setback, which is not, it's not an appropriate interpretation of grandfathering laws, but that's, they're gonna hold to it, and they're gonna see, we're obviously gonna have to get an attorney involved for that to try to figure out what we can do there.
So that's kind of the bad, but now there's some uglier parts of it as well. What are the ugly parts?
Well, the ugliest part of it is that the city, they've been after this owner for about 2 years. He's owned it for about 2 years, and this owner, his plan was when he put the park on LoopNet, he really just wanted to see if it would sell. And if it didn't sell, then he was going to just demolish the thing, and he was going to build townhomes on top of the park. So he was going to see if he can get rid of it without having to do anything. And if he couldn't, then he was just going to bulldoze the park, close it down, and then just erect a bunch of townhomes through there. So unfortunately for us, we're kind of at that point where he hasn't maintained the property over the last 2 years, and the city is starting to make some pretty serious threats. So there's a little bit of a drainage issue in the park where when it rains or when snow melts, which is another problem in Buffalo, is that it creates a lot of, there's really no place for the water to go. So a lot of times the water will just sit on the road. And then when it refreezes over, then the trash company, they can't get their trucks in there, and their guys can't get out to actually grab the trash cans. So they basically they lose trash service whenever snow starts to melt and then refreezes over, which has caused the city to threaten to pull their operating license if they don't get this drainage issue resolved. And they're about 2.5 months away from having their license pulled. And obviously this is going to have to be fixed before we close on the park. So that's probably the ugliest component of this park, is that we're under contract right now for a property that's in danger of losing its operating license, and we're not going to control the property before that happens, or we're not going to be able to fix it before it happens unless we really take a gamble and just try to fix it on our own dime and do it that way, or try to put it back on the seller. The second part of the ugly is their collections are in the dumps. They only get about 6 to 8 tenants that pay on time every month. They usually get most of their money every month, but they just haven't focused any attention on getting the rent collected in that park. Again, their goal is to just get rid of it and just wash their hands of this headache, or they're going to bulldoze the thing and do a development play on it. So they clearly really just don't care about what happens in this property.
Mm-hmm. Yeah, that's really scary. Really, two things that are very scary about losing the license to operate the park, but also the fact that the tenant, only 6 to 8 tenants actually pay in that grace period, before it's considered late. But I guess the positive note about the I guess delinquent tenants is that they're all tenant-owned homes. Actually, I'm sorry, Charles, with the exception of what I believe 1 or 2 park-owned that are actually occupied as rentals. The rest are tenant-owned homes. Is that correct? Yep. Okay.
Yeah,
so,
I think there's 1 park-owned home that's occupied.
Yeah, and there's a lot of residents that have lived here, 5, 10, 15. I think there's even a couple in there 20 plus years, and so getting them, that doesn't concern me too much, getting them to pay, because there are still a number of people in that park that have pride of ownership. And I mean, there's a few homes that are just, they haven't really kept up with things. But a lot of these residents have lived there a long time, and there's just no one forcing them. There's no one, forcing their hand to pay on time. There's no penalties. There's no repercussions. And so people get lackadaisical. I mean, if they're not being pressured to pay, they don't pay. They have other priorities. They put paying the cable bill and paying the internet bill on top of paying their rent because there's no repercussions. Their home's not going to get yanked out of there. They're not going to get an eviction notice, and so that's what they do. So let's talk about, Charles. I'd like to talk about what we're doing here in order to basically mitigate our risk and also to make a final determination of if we're going to pass or play. And so the first thing that Charles got back from his due diligence trip, and so I've kind of stepped into the role of, first off, before we need to figure out if we can bring homes in there. Like, that's one of our big upside. If we can't bring homes in there, if we can't bring new homes in to replace the old rundown junkers and also to put on the vacant lots, then the deal, we're going to walk away from it. It doesn't make sense. It doesn't have enough upside left in it for us to want to do it. And so we have to be able to bring these homes in, which means we've got to basically, we got to contend with the zoning issue. But before that, the more important thing is we have to make sure that we can actually get a moving truck in there, that a professional mover can actually make it in there and actually get a home set. And so the first thing, that the cheapest part of this whole process is we're going to pay a moving company. They're a local professional moving company. They're like an hour away. They're going to go up there this week sometime, actually, and they're going to assess the situation. We told them that we'd like to bring in 14 by 66 homes, and they're going to take a look at the empty spots. I gave them like an aerial map of the park, and I color coded the different empty lots as well as the junker homes that we're going to remove. And they're going to go in there and tell us if their trucks with the trailers can basically maneuver through there and get the home set in place. If they come back to us and they tell us, no, there's no chance in heck that we'll ever be able to get a truck in there or get a trailer in there, then that kills the deal right there. And we didn't really waste too much money other than a trip up there. We didn't spend money on attorneys and such. We'll back out of the deal. So that's the first thing we're doing now. If they come back to us and tell us that we definitely can fit them in, it might be a little tricky, but they've got the equipment and the wherewithal to do it. Then we'll do it. Then we'll move forward with hiring an attorney. That's the next step. We'll get a land use attorney involved. I've already spoken with somebody, and that land use attorney is basically going to go and interpret the existing code and see what our rights are and see if grandfathered law applies to us in this scenario, and whether or not we can bring these homes in without having to worry about that 100-foot buffer that Charles had mentioned. If that 100-foot buffer applies, then the deal's dead. I mean, if that sticks and we have to conform to that, the whole deal is dead. So it could fall apart there, once we get to that point. And we'll probably have another grand sunken into it at that point in time to figure that out. And then if it passes that test, if it passes the land use attorney test, and we know we can bring homes in, now the last thing that we have to contend with is the drainage issue, right? And the potential loss of the operating license. And so far, there's a quote. It's an old quote, and supposedly it's a very high quote, and it's inaccurate. But currently, there's a bid out of like $50,000 to fix this drainage issue. $50,000 is a lot of money for the size of a park, especially if it's a capital improvement that needs addressed immediately upon closing. And so we've got another company out there that's working on getting us a bid. I think we've got a civil engineer that's coming out to take a look at the issue, and we're waiting on a bid back on that. But also, once we get that bid back, we will definitely force the issue of getting the seller to address this, because it's something that's been on their plate for a while, and they've just been procrastinating, putting it off. And I don't think, Charles, that we really want to take on the liability of this and actually close on this thing, knowing that there's a risk of losing that operational license as soon as we take over. Mm-hmm. And so
absolutely,
we're going to do our best to retrain. I mean, really, it's their responsibility. This is actually one of those things that I can't imagine that they wouldn't be willing to work with us on if they really want to get rid of this park. I mean, this is something they've known about for a long time, and it should have been addressed, 1 or 2 years ago, but they've just been putting it off. And so anyway, we'll see what happens there. I don't think that's going to kill the deal. I think the part that's going to really kill the deal is if we find out that we either can't even get a moving company in there with the trailers, or if we can, but yet the code won't allow us to put new homes in because of that 100-foot buffer. That's going to be really what kills this deal. We have bank financing lined up. We've got 2 local banks that are willing to do this deal for us that have, and I wouldn't say super attractive financing, but the terms work. And we think that this park could be a moneymaker. I mean, but we have to be able to bring homes in. That is the end-all, be-all. We have to be able to bring homes in. We know there's a market for new homes. We know that we can raise rents. In fact, Charles, what are we thinking? So the market, conservatively speaking, is probably 450 or so. I mean, that's like the comps easily justify 440, 450. And so in this park, we feel very confident that we could easily take it to 375 without skipping a beat. Is that what we're thinking on this one?
Yeah, we'll probably take it to 375 or, maybe even 400 right out of the gate. It really just depends on what we can do. We really just haven't looked too much at that. We know what the comps are, but we really just haven't played around with those numbers yet because we're just trying to see if we even want the headache of trying to go through all these different processes just to purchase the park.
Yeah.
So
that's that. That's kind of where we're at with this one. Now we're somewhat in a holding pattern. We still have some time left on our inspection period before our money goes hard, and we need to get these worked out. And hopefully, and I actually, Charles, I feel pretty confident. I know we haven't talked about this, but I feel pretty confident that if a moving company tells us they can get homes in there, I have a good amount of confidence, not complete confidence, but I have a good amount of confidence with the right land use attorney that will probably be safe with bringing homes in to a certain extent. I don't know what that means yet, but I think that it will probably be in our favor that we should be able to bring homes in. Because there's actually a park, we didn't tell the listeners this, but there's a park right up the road, about a quarter of a mile away, that has been phasing out their older single wides and bringing in double wides. It's a big park. I don't know, over 100 spaces. And they have multiple, if you look at an aerial, they have multiple newer homes that were definitely put in after this code was put in place that do not meet that 100-foot buffer requirement. And so, there's a case to be made there that the park right up the road didn't conform to this, so why should we have to conform to it? And then we're also, again, the whole grandfather laws come into play. And we'll let a land use attorney kind of work their magic and see what happens. But I feel pretty confident if we can get past the moving of the new homes in. So, any other thoughts, Charles, on this park before we move on to the Alabama park?
Yeah, I guess I'd like to just touch on that grandfathering issue just so everyone's kind of clear on it. Grandfathering, if you imagine the park is one parcel, because that's what it is. It's one parcel. It makes up the entire 53 lots in this park. The city's interpretation is that, the grandfathering is really, it applies to the parcel that the park is on. You can't apply grandfathering laws to individual lots within the community. That's just not the way it works. So that's kind of that's what we're working with. The city's kind of got the opposite mentality, as they want to apply grandfathering laws just to the individual lots. So that's sort of the nature of this grandfathering issue.
Yeah. So we'll work it out. We'll figure it out. But the moral of this story is due diligence is so vitally important. I mean, it's just like, so on the front end, this park looks like a great deal. If you didn't dig deep like we just did there, I mean, you could seemingly maybe still end up okay with this park, and you could probably make money with it, but it wouldn't have all the upside that you were hoping for, going into it if you didn't do the type of digging that we just did there. And, it's just, it could be an opportunity, it might not be an opportunity. Again, and what makes an opportunity for us or what makes a good deal for us or a deal that we might pass on might not mean that it's a bad deal for everyone. Charles, like we might pass on this if we can't bring homes in, but someone could actually still do quite well with this one, but they just would be restricted. They wouldn't be able to bring homes in. They could probably go renovate those junkers that are in there, but they're really, you said they were pretty far gone. I don't know if you'd want to spend the money, but I guess you could if you wanted to. Could renovate those things and sell them off. Put $8,000 into them, sell them for about $2,000 a piece, right?
Yeah, when I went and looked at these homes, I had thought initially that I was trying to put a punch list together. It's usually what I do is I get a punch list together for what the home needs. I didn't even bother. That's how bad these were.
Knockdown is what you wrote down. Knockdown.
Yeah, just do whatever, smash it in place, and then carry it off. That's about all they're good for.
Bonfire. Okay, good deal. Well, next, guys, I want to talk about this park in Alabama and the challenge that we've been facing with the cash program. And to do that, I'm going to bring on Brian Spear. He's one of our partners in this deal, and he's been the one that's been really spearheading, working with Clayton and working with 21st Mortgage on this cash program. And so I'm going to bring him onto the phone line here, and I'm going to let him kind of give us the play-by-play. I guess game card of what this deals look like from the beginning and to where we're at today, and some of the challenges we've been having, as well as how we're overcoming those challenges. All right, guys, on the line, I still have Charles there as well as Brian Spear. Brian works with us with Sunrise Capital Investors, and he's one of our partners in the Alabama park that we did a case study on back in episode number 29. That park is located in Athens, Alabama. It's in the Huntsville MSA, and we did an entire episode on it. So I'd actually suggest if you didn't listen to that episode, go back and take a listen to it, because it will probably fill in a lot of the missing details that we might not cover in this particular review or update on this actual deal. So go back and listen to episode 29. It's got all the nitty-gritty about that park. But just a real high-level point of view, the park is 68 spaces. As I mentioned, it's in the Huntsville, Alabama MSA. We bought it back in October 2016. We paid $700,000 for it. We got really attractive owner financing in place, and it's a very unique deal. And not because we got owner financing, but it's a very unique deal because, number one, it was all rental homes. It was 45 2002 16 by 76 single wides, and then a huge double wide that was the manager's residence or the manager's office. The inventory alone on this park conservatively was worth, $500,000, $600,000. I mean, between $500,000 and $600,000, just the inventory alone. Again, we paid $700,000 for it, and that included all the inventory, and we got great owner financing on it. And also, in addition to that, another unique feature of this park is it was built back in 2002, and so it's fairly new. So the infrastructure is fairly new. Not many parks that you see out there nowadays that were built, in 2000 or post 2000, or even, in the 90s. Even you don't see many that are built in the 90s. Most of them are in the 60s and 70s, if not earlier. So our initial plan when we bought this park was to sell the units. I mean, we wanted to convert this park back into a tenant-owned type of community. In fact, it never was that. So we wanted to not turn it back into, but we wanted to turn it into a tenant-owned home community by utilizing the 21st Mortgage program, their financing that they offer, and sell off these rental homes to either the tenants that were living there currently or from people from the outside that wanted to come in and own a home, with attractive financing. And so what I'd like to do is I'm going to introduce Brian to the show, and since Brian's been spearheading this project for us, he's been really the point person for the whole sales program that we put in place. He's been the point person dealing with 21st Mortgage, getting these homes converted into tenant-owned homes. And so I'd like to have him share some of the challenge that we've been facing. And the reason that we're doing this, there's a whole underlying reason why we thought this would be valuable for you to tune into and to listen to, is that these conversions, we've converted many other parks that have had park-owned homes in them. They're a lot more challenging than what it may seem. And adding in the 21st Mortgage program has added a level of complexity to the conversion process of converting these rental units into tenant-owned homes. And so I want to share our experience, because if you're looking at parks that have a lot of park-owned homes and your idea is that you're just going to go in and turn them around right away and sell them off, offering financing, or you're going to sell them off for cash, and you're going to turn them into a tenant-owned home community really quickly, and it's going to be super easy, I want you to not necessarily think twice about the deal, but I just want you to be prepared for the amount of energy and effort that might have to take place in order for you to complete your plan. And so, Brian, welcome to the show. You there, bud?
Yeah, appreciate it, Kev. I guess I'll just take the ball and run with it here. But by now, the vast majority of our listeners, they're going to be well aware of our business model. We typically buy parks that have an undervalued net operating income for one reason or another, and we fix the broken pieces, whatever they may be. We own parks that are typically tenant-owned parks. I mean, we don't prefer to purchase rental homes or park-owned homes, but as is the case in many different parks throughout the country, there are typically a few park-owned homes in some of the parks that we acquire. But in this particular park, it was as you mentioned, a beast of a park in terms of park-owned homes. And the business model is such that we're going to try to get rid of them as soon as we possibly can. Because the assets that we had in this particular park were a little bit nicer in terms of the quality of homes that we had seen, we were trying to extract the most value that we possibly could from them, of course. But, it proved to be a little bit more difficult over time than what we had originally anticipated. We can probably sell these homes at a very, very reasonable rate and get out of them quickly, but because there's enough equity in each of these homes, we're trying to make the most of it. And, of course, we're using the cash program to do so. We speak often about the cash program and how it's a great opportunity for us to fill vacant lots for very, very minimal out-of-pocket expenses. But this was unique in that we're trying to implement their used home sales program for the first time in Blackburn. And we've had, as Kevin had mentioned, a few challenges along the way. The reason that we wanted to implement this particular program as opposed to going through a rent credit program or a similar version of a seller finance program is that when we actually do the 21st used home sales program, they actually will cut us a check for the entirety of the sale value. So, for instance, if we were to sell a home for $15,000 via rent credit, it's going to take us a long time to get paid back on that. The same if we do a rent-to-own. You're going to get a small down payment, and then over time the tenant is going to pay that home down. But with the 21st Used Home Program, we actually the tenants are receiving financing directly from 21st, and we're receiving the entire amount of the sales price on the back end. So we're receiving large chunks of cash each time that we turn one of these homes. It's a really, really beautiful thing, and in theory, it's phenomenal. But we've run into a few snags along the way. And I guess I'll go into a couple of the details on some of the difficulties that we've seen. First and foremost, we're not dealing with the most credit-worthy tenants on the block. A lot of these folks have had issues in the past. You're not going to find a lot of folks in this space that have unblemished credit, and they often have sometimes meager income or not phenomenal income, and for that reason, it's more difficult to get these folks financed. That's understandable, no doubt about it. But for whatever reason, in the 21st program, we've come to the realization that 21st it almost seems that they put more of an onus. They definitely would prefer to sell new homes as opposed to the used homes. And I believe that's because they're in tandem, of course, with Clayton Homes. I mean, when they manufacture these homes and finance them on the back end, it would make sense to me at least that they would prefer to go ahead and sell the newer homes as opposed to some of the used inventory that we have. They don't make near as much money individually on each transaction as they do on the new home sales. And for that reason, we're finding actual instances where we'll try to sell a park-owned home for about $15,000 or so, and our tenant will be declined for an amount such as that. But then, our sales representative for 21st will say, hey, let's see if we can get them approved for a new home in the $35,000 range or something along those lines. It's unbelievable. It's counterintuitive, and it makes you kind of pause and rethink where we stand in the cycle. But again, as Kevin had alluded to, we're just seeing a couple of hiccups along the way. This is still a phenomenal deal, and we're going to make it. And it's a great equity play over time. But it's over the first 6 months, it has proven to be a little more time intensive. It's still a phenomenal deal, and it's going to be a home run over the long term. But these are just the kind of things that you need to realize when you're acquiring a park. Not everything is going to go as smoothly as what you had originally planned. Sometimes you just need to pivot and adjust accordingly. So that's kind of what we're going through right now. So go ahead, Kev. Do you have further questions?
Yeah. So, we always plan, when we go into buying any park, including Blackburn, which is this park in Alabama, we always plan for the worst case scenario. And, that's why we like buying parks at discounts. That's why we really negotiate really good seller financing terms a lot of times. And that's why we got to have that buffer there because we don't know what we don't know. And in this park, the components that we didn't know is, number one, we didn't know how good the tenants really were. It's you get profit and loss statements, and you get the rent rolls from the owners, and you hope that they're being honest with everything, and you get deposit statements, and you hope that there's no fraudulent activity happening where they're not fudging numbers. And so we try to confirm everything and verify everything. But with that being said, you still just don't even know the quality of residents that you have in there. And so again, we always plan on going into a park and losing residents. I mean, once we actually enforce rules and enforce a no pay, no stay policy, we always intend to lose residents. Okay. And so, with that being said, this park, we actually ended up. I mean, there's actually more bad in there than what we initially thought, but we had already planned a buffer in there, and so we lost some more, a little bit more tenants than what we initially anticipated. But it's okay because we needed units to sell anyway, so it didn't really make a difference. We were actually pretty happy to move out the bad blood. We wanted to get rid of them because we wanted to renovate units so we could have make available for sale, so we could sell them in this program. But the part that was a little surprising to us, Brian and Charles, is that we kind of went into this with a very conservative projection. We kind of told each other, well, if we can only convert like 10% of the existing tenant base into owners, because the cash program, the 21st mortgage program, the financing that they are offering, $250 a month is our lot rent. And so the financing on top of that, based on the sales price that we're selling these homes for, their monthly payment, including principal, interest, taxes, and insurance, would have been, pretty much right in line with what they were paying in rent. And so in our minds, we were like, this is a no-brainer. And we actually haven't converted. We converted one tenant that was living in there, and everyone else is coming from the outside in. And so our conversion process has been slightly more expensive because we basically have had to not necessarily force out the renters, but we've been, not giving really anyone any chances. So if they're late, we start filing eviction. If they're a nuisance, we give them a non-renewal. And so we're somewhat pushing out the bad to bring in the good from the outside, but every time we do that, we have to renovate a unit. So we have a renovation cost. And so, again, we planned for this. We planned for worst case scenarios. That's why we buy parks at discounts. We bought this park at $700,000. Realistically, if this thing would have sold in the open market, it probably would have sold for over $1 million any day. In fact, it probably would definitely been over $1 million. And so, I guess, Brian and Charles, and I'll speak for myself real quick about this, and then maybe you guys can chime in and give me your own opinions. But the lessons that we've, I guess the lessons we've learned from this particular park, and I think we kind of knew these lessons going in, but I guess just they were kind of set in stone with this particular park, or they were put in concrete, is that don't put very much value on your park-owned units when you're purchasing. And we didn't on these. It's funny because we bought this park, and the reason why we didn't put a lot of value in them, or the reason why we didn't have to pay a lot for them, is because the owner didn't really see a lot of value in them. Although they were actually worth a good bit of money. On average, these things are worth like 17, 18 grand NADA value. In his mind, they were worth $5,000. And so our release amount was $5,000. So we were essentially paying $5,000 for these homes. And so, but what that did is that gave us plenty of room. And so in our minds, when we bought this park, we went in saying, hey, worst case scenario, again, we plan for worst case scenario. If the worst case scenario is we literally fire sale these things for $5,000 a piece just to basically get clear title on them, then we still come out way ahead. Because now we have a fully tenant-owned park, where we've got a very low basis point in now. I forget what the numbers came out to be, guys. We'd ended up owing like $350,000 principal balance on the park, and our payments are really low. And it'd be a beautiful situation even if we just sold these homes for $5,000 cash a piece. So that was our worst case scenario. But again, the lesson learned here is don't put a lot of value in your park owned units. Just don't. You got to get them at the right price so that you can have a exit of just selling them for cash very quickly if need be, if the financing option, or if selling them for NADA just doesn't work in the market you're in. Also, don't assume that you'll convert a large majority of your existing renters into homeowners. Even if and every market's different, but just be prepared that you might not convert as many as what you think. Even if the monthly payment will be about the same. As I mentioned, our monthly payment was just about the same for them buying as they were renting, and yet we just didn't convert. We converted one. That was it. And I can tell you that renters just have a different mindset than that of homeowners. They just do. They just think differently. In their mind, they want to rent and they don't want to fix anything. They don't want responsibility. They want the ability to be transient. Whereas homeowners, they want to stay put and they want to own something. They want to actually, set their flag down and say, this is mine. And it's just, they're two different types of people. Last lesson, guys, that I kind of learned with this particular park. Again, there's lots of moving pieces in this park, lots of things to happen, meaning like lots of activity on a daily basis to really hit our goals and to hit our numbers. And what we found pretty quickly is that the manager that we acquired when we bought this park, although she probably would have worked out in the normal park, I mean, if any of the other parks we owned, she probably would have done just fine. In this park, we needed a rock star salesperson because we needed to be selling homes, and we needed something that was going to be aggressive, not just in the sales process, but also in the collections process, because we had to fix a collection issue, but we also had to sell homes. And we found out pretty quickly that she just didn't really fit the mold. In fact, we found out quickly, but we didn't make the change as fast as we should have. We should have done it a little bit sooner. But it's really challenging to find a really rock star salesperson that's going to, be willing to live and manage your park for you. So, those are the kind of lessons that I learned from this particular deal. I don't know if you guys have any other feedback or opinions on that in addition to what I just mentioned there, but go for it if you do.
Yeah, I would just say that we need to be flexible with how you operate the park once you're up and running. I mean, again, as you had mentioned, you'd alluded to the fact that our initial goal and our projections were that we'd be able to sell at least a few of these homes. We'd be able to transition some of these actual renters into homeowners over time. But as you'd mentioned, look, they just have a different mindset entirely. So we had to pivot our marketing approach. We had created a nice sales PowerPoint presentation to all the tenants, so on and so forth. And I mean, that just didn't work. So we had to pivot. We had to trash that approach and move towards heavily marketing to the Huntsville MSA. And that's a phenomenal backdrop for us. It's a safety net for us, and it's why we have to focus on such a phenomenal market to begin with. This park is in one of the fastest growing MSAs in the country. So when we did run into that little bit of a struggle with transitioning actual renters to homeowners, we can rely on the fact that this MSA has enough income in the vicinity to actually bring in new homeowners. I mean, this was a park where just a few weeks ago we were able to sell a home for $15,000 cash. The demand is there for these homes. We've got a ton of people coming in through the door every day, but it's going to be a process to get this park turned around. It's not going to happen overnight. We've got a lot of applications coming in, but as we had mentioned, 21st is having some difficulties approving some of these folks. No problems there. We need to sift through and find the right applicants and the right folks for our community. But again, whenever you take over a park that has a lot of park-owned homes, just plan on spending a little bit of time and effort turning it around. Just prepare yourself, because it's going to take a while to get where you want to be. This deal is going to be phenomenal, but again, it's a long-term play. It's not something that's going to happen overnight. So that's all that I would say.
No. And just to reiterate, don't pay too much for your park-owned homes. I mean, you need to have multiple exits out of those park-owned homes. Don't set all your faith in the 21st Mortgage Program or any other bank that's going to offer financing to these residents. Right now, we're in a lending climate to where, again, very similar like 2007, even people with tarnished credit can get financing. Well, that might change. I mean, we might go through another, slight recession or correction to where lending gets a little tighter, to where, some of these loan programs might not be around. So you got to have an exit. Like for us, our exit on this deal is that we know that we can get out of these things. If we put these up on Craigslist right now and try and start selling them for $7-8 a pop for cash, we would have cash buyers plowing down our manager door saying, I want to buy these darn things. Okay. So that's our exit, and we still win. And so don't feel bad for us, because this deal is actually going quite well in the grand scheme of things. It's just taking a little bit longer, and it's become a little more challenging because of some of the hiccups we've had with the 21st Mortgage Program. But it's fine, because again, we have multiple safety nets in place. We bought in the right market. The market has high demand for affordable housing. And so it's just we always prepare for the worst. I think that's the whole moral of the story here. I know a lot of you have reached out to me over the last couple of months. I've spoken to a few of you personally about buying parks that have a ton of park-owned homes and looking at your evaluations and seeing what kind of value you're putting on those homes. And it's just too high. And a lot of those homes that you were showing me are older than the ones that we have in this park. And so I think that's it. Charles, anything else you want to add before we say goodbye here for the day?
Yeah. I think that one of the things that we've learned about 21st, we really like using their new home financing program. We really don't have a whole lot of challenges with that, but it almost seems like it's, I don't know, maybe it's 10 times harder to sell a used home through their program than it is a new home. We can get applicants approved all day long for new homes, and as long as we can get the inventory in there, then we can sell new homes about as quickly as we can get them in there. But the used homes, it seems like for whatever reason, they want someone that has a better credit score or is going to put a bigger down payment down. We've had tenants that they might have to put a $5,000 down payment down to buy a $17,000 used home, whereas they could put a $3,000 down payment down to do a $30,000 new home.
Yeah.
And their requirements are a lot less stringent on the new home. So we didn't really anticipate that on the front end, and that's probably the biggest moral of this story, is that if you're looking at using the used home sales program, then just realize you're getting yourself into a lot of work, and it's a lot more challenging than it may look on the front end.
Mm-hmm. But there's profit if you buy right in the front end, right? We always make profit when we buy. That's what we say. You make your money on the front end, so you just got to buy right. We bought right, and everything will be fine for us in the long run. It's fine now, Just we don't want you guys to make the mistakes, okay? And so that's it, guys. Really appreciate it, Brian. Appreciate you coming on the show and sharing your wisdom with us about your experiences with the cash program and selling these used homes and getting this place converted back to a tenant-owned home community, which it will be. And give it a year and a half, and that place will be a complete turnaround. And we've already ordered a bunch of new homes for it. I think we have about 8 or so coming in the next month or so. Over the next month, we have eight new homes coming in, or more than that. I don't know. We have a lot coming in. So that thing's going to be a gorgeous park, and we're going to have a very happy homeowner community there. And, we'll look back in this day a year and a half from now and say, look what we did. Look at the money we're making. This is phenomenal. but it took a lot of work to get there. And so we just want you guys to be prepared for the work you're about to put in on something like this. So, guys, I appreciate your time here. And that's all we have for today's episode. But real quick before we say goodbye, I just want to remind you guys of the free gift that we offer to listeners who take the time to go over to iTunes, leave a 5-star rating and review. As you know, we buy a lot of our properties going direct to owners, off market, and we do cold calling and we do direct mail. Those are our two main methods. And so we are going to give you the exact cold call script that we use in our very own business if you go over to iTunes and leave that review and that rating. And here's how you're going to redeem that free gift from us. After you submit the review to iTunes, go ahead and send us an email to gift@mobilehomeparkacademy.com. Just tell us who you are and what screen name that you use to leave that review, and we'll go ahead and send you that free gift. Also, be sure to stop by the Mobile Home Park Academy website at mobilehomeparkacademy.com. You can listen to all these previous podcast shows that we have here, as well as get a free copy of our popular ebook, The 21 Biggest Mistakes New Investors Make When Purchasing Their First Mobile Home Park and How to Avoid Them. And in addition to that, as I mentioned in the beginning of the show, we also have a free 2-hour training that Charles and I just put up on market analysis, building your comprehensive mobile home park database, and how to market and find off-market deals, okay? You can get all that information and more by going to mobilehomeparkacademy.com. Guys, this is Kevin Bupp
and Charles Dehart
signing off.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.